So in this video, we're going to talk about the cash flow statement itself and how we can measure overall cash flows. So if you think about developing the cash flow statements, we've talked about this in other videos. There's three things that we're primarily interested in. What kind of cash flow comes from operations? What kind of cash flow comes from investing activities? And what kind of cash flow comes from financing activities? The financing activities is one of the simpler parts of this because there are only certain things that can happen. You can either buy or sell stock. You can either buy or buy back or issue more debt. You can pay interest. You can pay dividends. Those are the only activities that are in the financial piece. So the other pieces are sometimes a little bit more complicated, especially in the prediction part of analyzing a company. So how do we develop this cash flow statement? Now, I'm not keen, if you will, in a corporate finance course to talk about how we actually create statements. But I think it is interesting to understand at least how these things are ultimately reported to us. So any decrease in an asset is an inflow of cash, right? How'd you get rid of the asset? Well, you probably sold it. That means you received cash. So any increase in asset is obviously an outflow. Any decrease in liability is an outflow of cash. How did you get rid of the debt? You must have sold an asset or used cash in order to get rid of that liability. Depreciation and amortization are what we refer to as non-cash charges. So these are identified in cash flow because net income reflects the bottom line, but it reflects these expenses that required no cash to do them. So again, in the statements, we typically only see gross net fixed assets. We don't see the depreciation line item. In most income statements, we certainly don't see depreciation. In a balance sheet, we could see a line item called accumulated depreciation, but in most instances, we see the term net fixed assets, which shows the amount of assets we have net all of the depreciation that's been taken. So to develop these statements, we need to know all the cash inflows as well as net profit after taxes and depreciation, so we can identify those things. We also need to know all the outflows, right? Any losses we have, any values, obviously, that we've received from selling assets, and we need to know what kinds of outflows in general have occurred, such as dividend payments. So here we have an example, and I'm not going to spend a lot of time with these statements because you can review them yourself. But here we have our income statement for this company, Baker Corporation. We have identified also its balance sheet, right? So here are its assets and its short-term financing. We see that. We also then see the ending part of the balance sheet, which is the remainder of its liabilities and equity section. So we can see the line items. Now we need to figure out how do we figure out the cash flow from operations. As you notice here, we have net profits at the top. Then you add depreciation. Now these line items then are all, as we said, if you decrease accounts receivable, that must have meant you received money. If the asset goes down, that implies money was received, right? You had to sell it. And that's how we do these numbers. You see here, a decrease in referrals, that means there is an outflow of cash. How did we get rid of the accrual, which is a liability? We must have used cash for that. So in this case, we end up with $837 came from operating activities. We then review the changes in gross fixed assets, any other equity investments the company has. So now we have the cash provided by investing. Notice it's a negative number. Having this negative is not a problem. If the cash flow from operations is negative, that's a huge red flag for the company. Now we look at the cash flow from financing. Now we see what? That we have some cash provided here. Total is $20. It means what? We increased long-term debt. We borrowed $200. However, we paid off some notes payable, and we also bought back or paid out some dividends. So that's the outflows. So the net cash change for this company, if you add those three line items up, we end up that the cash for this company should have increased $557. So now let's talk more about how we use this in management, right? What's that process? So we want to measure the company's operating cash flow. How can we do that? So again, the marginal tax rate with the most recent tax change has been 21%. So historically, if you remember from previous videos, this could have been as high as 35 or more percent. Right now it's 21%. But again, and for proprietors and partnerships, obviously individual rates apply. How do we find operating cash flow? The first part, we need NOPAT, right? Net operating profit after taxes. And I don't think I've mentioned this earlier, but finance is filled with acronyms, right? So the sooner you get used to the acronyms, the easier this ultimately becomes as far as understanding what's going on in the formulas. So NOPAT, net operating profit after taxes, equals EBIT, earnings before interest and taxes, multiplied by 1 minus the tax rate. So the operating cash flow is NOPAT plus depreciation. So let's see, we have this example from Baker. If you go back and you look at the financial statements, we end up with $370 was the EBIT. Subtract that, 1 minus 21%, add the depreciation. We end up with $392.3, add 2 zeros to get to 100,000. That is the operating cash flow of this company. So again, we can conclude from this, we only have one number, at least the number is not negative. So from business, from running this company, we are generating positive cash flow from operations. What about free cash flow? What is the definition of this? Free cash flow is the amount of cash flow available to investors after we've paid all of our operating needs and we've also invested in everything we want to invest in. All the plant and equipment, we've bought all of that we want. Any changes in net current assets, we've done all of that we want. So basically, we've done everything we want to do, except paid our investors. This is the cash left over to do that. So the free cash flow, the formula is the operating cash flow minus net fixed asset investment. We just take the change in net fixed assets, add depreciation, and then we take the net current asset investment. Now that is the change in current assets minus the change in accounts payable and accruals. Well, why don't we just say current liabilities, right? Change in current assets minus the change in current liabilities. Investors receive interest. So any line item we have that pays interest cannot be included in this free cash flow because it represents the money to be paid outside the company. So that's a little confusing. So if a company has some short-term notes payable, we don't want to include that here because there is interest attached to that type of line item. So let's go back to our example. What is the net fixed assets for this company? Well, we have change in fixed assets. It increased $200. There was $100 of depreciation. So the net fixed assets increased $300,000. And of course, this is a cash outflow because we bought this asset. The assets increased. What about the change in current assets? Again, if you review the line items, the change in current assets was $157. So we increased current assets, but we also had a change in accounts payable. So we're subtracting that change. And of course, we can see that it is an increase. So we're subtracting $100, the increase in accounts payable. So that means that the total change in current assets is $57. So what is the free cash flow of Baker? Take the operating cash flow that we calculated, 392.3, subtract out the change in fixed assets, subtract out the change in current assets. We end up with 35.3 is the free cash flow. Again, times 100,000, right? So it's $350,300. So they have generated cash flow to cover or to now attribute to its investors. So what does this mean? How well did we do? Well, if you look at the interest expense for Baker, you'll see that their interest expense was $70,000. So even though we're generating free cash flow, it's not enough to provide sufficient funds for its investors. Investors are going to see this, right? Particularly the creditors are going to note that you're not creating enough cash to cover the actual interest expense. Now, that doesn't mean they're going to default. It's just a signal. It's a red flag. And if we don't have enough money to pay interest, we also then don't have enough money to pay dividends. So again, this is a flag that this company, investors, shareholders, and creditors are going to be concerned about this company's free cash flow position. Hope you enjoyed that video. I'll see you soon.